Welcome to The Debate. Right now, the world's oldest fossil fuel giants are, well, they're quietly trying to transform themselves into the backbone of the artificial intelligence revolution.
And struggling to do it, I might add.
Well, they are attempting to orchestrate what is, frankly, an unprecedented capital deployment supercycle. It's this massive financial juggling act, right? They have to maintain traditional energy security for today while simultaneously funding the explosive structural power demands of tomorrow's data centers.
I mean, juggling is one word for it. I'd say the sheer weight of that act is fracturing their balance sheets. We are watching an entire industry step right into a massive capex trap.
A trap?
Yes, a trap. They are committing to astronomical capital expenditures that they simply cannot afford under, traditional financial models.
See, I look at the exact same data and I see a remarkable success story unfolding. I'd argue that the industry is executing a really disciplined dual-track strategy.
Dual track? That implies they're actually moving forward on both.
They are. We are seeing these companies systematically harvest record free cash flow from their legacy oil, gas, and refining assets. And then they are taking that exact cash and using it to self-fund a transformative pivot into the electrification and AI-powered era.
Right, but at what cost?
Well, all without cutting their dividends or sacrificing shareholder returns. They're essentially rebuilding the airplane's engine mid-flight, using parts funded by selling off the old landing gear.
Yeah, the problem with that metaphor is that where you sell the landing gear, you eventually still have to land.
I mean, sure, but
I argue that this entire dual-track narrative is just an illusion. It looks like strategic discipline on paper, but it masks profound vulnerabilities in their capital structures.
I disagree. They are managing the transition.
Are they? They're simultaneously pursuing massive fossil fuel megaprojects while trying to build out extremely capital-intensive green transition assets. You just cannot do both at this scale. The execution risk, the geopolitical instability, and frankly, the sheer regulatory weight of doing this concurrently means traditional funding models are going to break under the pressure.
Well, let's break down exactly how they are pulling this off, because the mechanics of this capital rotation are actually fascinating.
Okay, let's hear it.
The core of my argument rests on something called portfolio de-averaging. Companies are looking at their massive global footprints and, well, ruthlessly shedding assets that no longer fit the future. It frees up billions in dormant capital.
So they are selling off their reliable cash cows?
They are concentrating their bets. Take Chevron, for example. They are divesting over $2 billion in Southeast Asian and Australian downstream assets. Why?
To plug holes in the balance sheet?
No, to take that cash and funnel it directly into high-impact deep-water exploration. Or look at Sempra Infrastructure. They just successfully transitioned their ECALNG Phase 1 terminal in Mexico.
Right, the one that was a massive capital sink during construction.
Exactly. But now it's a de-risked, cash-generating asset now that it is finally pumping out its first gas. They crossed the finish line.
Look, I don't disagree that some individual projects are crossing the finish line, but at what cost to the broader corporate treasury? When you look across the entire sector, the math just doesn't add up without pushing these companies to the brink.
The brink is a bit dramatic, don't you think?
Not at all. If you want to see the future of this capex trap, look at the state-owned players, the national oil companies. They are the absolute canary in the coal mine here. Take Pemex, for instance.
Well, Pemex has its own specific issues.
They are staring down a $15 billion annual funding gap. $15 billion. And Mexico State Utility, CFE, just suffered a Moody's downgrade to BA3.
Right, sitting on the edge of junk status.
Exactly. Their highly touted 7-gigawatt renewable plan is virtually stalled. And look at Petroperu. They require a $2 billion sovereign lifeline just to keep existing refineries running amid severe governance crises. They are trying to fund the future and the present, and it's literally bankrupting them.
Wait, hold on. Let me stop you there. You're pointing to state-owned entities. Pemex and CFE have incredibly unique sovereign mandates.
Capital strain is capital strain.
No, it's different. The Mexican government literally forces Pemex to refine domestically at a loss to maintain local employment and fuel subsidies rather than, exporting crude at a global premium. You really can't compare the inefficiencies of a state-run monopoly to the strategic capital allocation of a publicly traded supermajor.
Okay, that is a fair distinction regarding sovereign mandates, I'll give you that. But my point is that the financial strain is universal. The majors are facing massive capital overhangs too.
Where?
Look at Woodside's $30 billion Browse LNG project in Australia. It is completely stalled. Having a $30 billion asset stuck in development limbo is a catastrophic drag on your return on invested capital.
Sure, permitting delays happen.
Or look at Ecopetrol. They literally had to admit to the SEC that rating agency pressures could force them to postpone their transition plans entirely. The ambition to capture this new AI-driven growth is blinding the market to the immediate working capital strains of actually building these things.
Okay, I see why you think the ambition is blinding, but I would argue the ambition is entirely justified by the mechanics of what's happening with AI right now.
Justified how? It's a gold rush.
The sector is radically restructuring to capture a generational demand shock. This isn't just about building wind farms to hit an emissions target anymore. It is about powering the intelligence era. Let's look at Halliburton.
An oilfield services company?
Traditionally, yes. They frack wells. But they recently executed a massive strategic pivot. They poured $1 billion into a company called VoltaGrid, and they acquired software firms like informational.
Right, and how does an oilfield services company justify getting into data center power generation to its investors?
Because the mechanics of power generation are converging. Think about it. Halliburton uses massive amounts of mobile power for their fracking fleets.
Sure.
And VoltaGrid specializes in mobile off-grid power generation. Halliburton realized that the exact same mobile microgrids they use for oil fields can be deployed to power massive AI data centers that simply cannot wait 5 years for a standard grid connection.
So they are renting out generators to tech companies?
They are deliberately moving up the value chain to capture long-term infrastructure margins, instead of relying purely on cyclical oil exploration margins. And on a macro level, NextEra Energy's ambition to consolidate Dominion Energy in a $66.8 billion mega merger proves this point. Scale is literally the only way to fund the trillion-dollar grid upgrades required for AI.
I understand the operational synergy between mobile power for fracking and mobile power for data centers. But mechanically, how do you explain the valuation mismatch to your shareholders?
What mismatch?
If I am a traditional oilfield services investor, I expect a specific kind of financial return. I want yield tied to the commodity cycle. I want fast paybacks. I do not want my capital tied up in a long-duration, 20-year infrastructure project with a much lower international rate of return.
But the long-term cash flow.
You are mixing two entirely different cost of capital models under one corporate roof. The market usually punishes that kind of conglomerate structure with a massive discount.
But the market will reward whoever owns the infrastructure. I view the current AI power build-out exactly like the late 90s telecom fiber optic boom.
Oh, you do not want to use that analogy.
Let me finish. The energy companies that secure the generation and transmission scale right now will own the foundational infrastructure of the next economic era. That future cash flow completely justifies the upfront capital intensity today. If you don't build the capacity now, you miss the century's biggest growth vector.
It is incredible that you bring up the telecom analogy, because the late 90s fiber boom ended in one of the most spectacular capex busts in modern corporate history.
They were early, not wrong.
Telecom companies laid thousands of miles of dark fiber across the ocean, crushed their balance sheets with debt, and went completely bankrupt years before the actual consumer demand caught up with the capacity. We are seeing the exact same early warning signs of local execution risk right now.
In what way? The demand for AI power is already here. It's palpable.
The demand is here, but the execution is lagging. NextEra's AI grid ambitions are already hitting local regulatory and permitting snags. We are seeing it in places like Sedgwick County, Kansas, and across Virginia.
The local pushback is standard for utility projects.
But this is the crucial mechanism people miss. When you have billions of dollars deployed, But a local utility commission delays your operational start date by 3 years. You create a massive lag between when you spend the capital and when you actually generate cash flow.
Well, yes, working capital gets stretched.
You are paying interest on billions of dollars of debt, but no money is coming in the door. That is exactly how credit ratings get downgraded.
That is a very real execution risk, I admit. But here is where my argument about portfolio rotation comes back in. The difference between the telecom bust and today's energy supercycle is how it's being funded.
With massive debt?
No! These companies aren't just borrowing blindly from banks like the telecom guys did. They are funding this build-out through incredibly disciplined portfolio pruning. They are self-funding.
Oh, by selling off their reliable assets?
By locking in peak value on legacy assets to fund the future. Look at what ENGIE is doing. They are divesting their politically sensitive Belgian nuclear fleet.
Which was a massive cash generator.
But it carries huge maintenance and regulatory liabilities. They sold it specifically to fund a 1.1 gigawatt Latin American renewable buildout. Or look at Ryzen. They are selling their highly volatile Argentine downstream refining operations to Mercuria to focus entirely on core Brazilian bioenergy.
Tripping the fat.
Exactly. Total Energies and Repsol are taking the incredible windfall profits they are currently making from their downstream refining and trading desks and using that cash to self-fund green hydrogen and biofuels. They are literally taking peak cash from the past to build the future.
Let's follow the logic of that rotation, though. What are they actually rotating into? Mechanically, they are trading known cash-flowing risks for unknown low-margin risks.
I wouldn't call them unknown.
Let's look closely at ENGIE's pivot to Latin America. They sold off European nuclear to deploy massive capital into emerging market renewables. And what happened? Recently, a single Peruvian pipeline failure crushed their regional operational profit, their EBITDA, by 49% in a single quarter.
Okay, that was an anomaly.
Half of their profit wiped out by one pipeline failure. That is the reality of emerging market infrastructure risk.
Emerging markets inherently carry volatility.
But the mechanism of how they fund it changes entirely. When you sell your highly reliable cash-generative downstream assets to fund high-risk greenfield renewables, you lose your internal treasury engine.
You still have a diversified portfolio.
You don't have that daily cash flow anymore, so when the pipeline breaks or the project gets delayed by 3 years in Kansas, you're forced to rely on external project finance to cover the gap. And in today's higher interest rate environment, external project finance is brutally expensive.
Look, I hear you on the pipeline disruptions, but your argument assumes the legacy hydrocarbon infrastructure will remain universally cash generative forever, which we both know it won't. You have to monetize it while the valuations are high.
I'm just saying the replacement assets are riskier.
But it's not just renewables they are building. We are currently seeing a massive inflection point in midstream and LNG projects that is fundamentally stabilizing corporate risk profiles.
Stabilizing? How so?
Because major capital is finally crossing the finish line. We talked about Sembra's ECA LNG Phase 1 and BP's Caspian ACG project achieving first gas. Mechanically, when a mega project moves from construction to operations, its financial profile transforms completely.
Sure, it starts generating revenue.
It stops burning cash and starts printing it. More importantly, they can now refinance. They can replace the high-cost, high-risk construction debt they used to build the terminal with low-cost, investment-grade operational debt because the asset is now proven to work.
Refinancing is great, assuming the market holds up.
It is holding up. We are seeing the Vaca Muerta shale in Argentina finally move to full-scale export, backed by Chevron's proposed $13.8 billion El Trapial investment. These aren't risky greenfield bets. These are massive, stable cash flow anchors being dropped into the global financial system.
You look at LNG and see stability. I look at the exact same assets and see looming merchant risk and a massive structural overhang.
What overhang? LNG is the bridge fuel of the century.
Let's talk about the mechanics of how these LNG deals are actually structured, because it's not as safe as it looks. Look at the major trading house Gunvor. They just locked into a 20-year U.S. LNG supply agreement from the Delfin floating LNG project.
On paper, it looks like brilliant energy security.
I mean, securing 2 decades of U.S. supply is a massive win for a global trader. But look at the currency mechanics. By locking into U.S. supply,
Gunvor is introducing massive, unhedged structural foreign exchange exposure. They are committing to 20 years of US dollar-denominated costs.
Right, that's the standard for U.S. LNG.
But they sell that gas globally, to Europe in euros, to Asia in yen. If the US dollar strengthens significantly over the next decade, their costs skyrocket while their revenues shrink. You cannot easily hedge 20 years of currency mismatch. That is a treasury nightmare waiting to happen.
Come on, sophisticated trading houses like Gunvor have the hedging architecture to manage those macro cycles. They've navigated currency swings for decades.
But even the super majors are struggling with the geographic and regulatory risk profile of these baseload projects. You just praised Chevron for pouring $13.8 billion into Argentina's Vaca Muerta.
Which is a world-class resource.
At the exact same time they are doing that, Chevron's Australian leadership is warning that proposed domestic gas reservation policies could literally strand their legacy assets in Australia. Do you see the contradiction?
It's just a shifting global portfolio.
They are pouring billions into an emerging market with a history of capital controls, while their cornerstone assets in Australia, a supposedly safe OECD market, are facing severe regulatory headwinds that might prevent them from exporting their own gas. The geographic risk profile of the industry's foundational cash flow is highly unstable right now.
Geopolitical volatility is a constant in the energy sector. The market prices that in. And frankly, the recognition of that exact complexity is why we are seeing such a dramatic shift in how these massive projects are structurally financed.
Which brings us back to the sovereign issue, doesn't it?
Exactly. Let's circle back to your point about the sovereign squeeze. You view entities like the national oil companies as the breaking point of this whole system.
Without a doubt. The sovereign utility and NOC models are structurally breaking. We discussed Pemex and CFE. State mandates for energy security just cannot be funded by traditional corporate debt anymore when the sovereign balance sheet is suffocating.
It's definitely tight.
And it's not just operational inefficiency. Pemex has an estimated $532 billion environmental liability hanging over it. $500 billion.
That is a staggering number, yes.
That is a structural wall. You cannot issue international bonds to fund a green transition when you have $500 billion of unmitigated environmental liability sitting on your balance sheet.
Look, I don't disagree on the strain those sovereign entities are under. It's immense. But I'm just not convinced by your overall pessimism because you are ignoring how the industry is mechanically adapting to bypass that exact problem.
Adapting how?
Is this sovereign strain not exactly why we are seeing a massive surge in strategic joint ventures?
Well, JVs are a symptom of the strain, not a cure.
I argue they are a brilliant structural adaptation. Look at the intelligence from our source material. Ecopetrol is managing its massive capital expenditures by farming down to Parex for upstream development.
Sure, sharing the cost.
Pemex, despite all the challenges you listed, is successfully partnering with Petrobras for deep water exploration. ADNOC in the UAE is formalizing long-term agreements with McDermott for massive project management.
But mechanically, what does a joint venture actually solve here?
It solves the balance sheet fracture. By forming a joint venture, these companies are successfully shifting construction and sovereign risk off the main corporate balance sheet and onto specialized capital. They are isolating the risk.
Like a shell company?
Mechanically, they create a new ring-fenced LLC for the project. The debt sits on that new entity, not on the parent company. By bringing in specialized partners, they create an entity that can attract project finance completely independently of the parent company's credit rating. This is exactly how you bypass the sovereign squeeze.
So they hide the debt.
You compartmentalize the massive capital requirements so a single project delay doesn't trigger a downgrade for the central corporate treasury.
Okay, compartmentalizing risk is a beautiful theory, but let's talk about how that works in practice. When you ring-fence a mega project, you are introducing massive governance complexity.
Complexity is just part of doing business at this scale.
Imagine you have 3 different partners. A sovereign entity with political goals, an infrastructure fund that wants steady yield, and an oil major that wants fast execution.
Okay.
Now imagine an inflationary supply chain crisis hits, and the project suddenly needs a $2 billion capital call to keep going. Who puts up the cash? Their incentives are entirely misaligned. Things fall apart.
Well, the contracts dictate the terms.
Joint ventures don't magically eliminate execution risk.
They just distribute the liability across more lawyers. When the project defaults, the parent company almost always has to step in to save its reputation anyway. So the ring fence is essentially an illusion.
It's not an illusion. It's a necessary evolution of risk sharing. You simply cannot build a $20 billion offshore facility on a single balance sheet anymore.
You know what? On that specific point, I will actually concede. Traditional corporate debt, just issuing bonds from the parent company, is no longer sufficient to fund this supercycle. On that, we are looking at the exact same data and coming to the same conclusion.
I think that is a crucial convergence in our perspectives. When we look at the sheer scale of the concurrent mega projects globally, from NextEra's massive grid ambitions in the US to Chevron's Vaca Muerta investments in Argentina, we both agree that the old playbook is dead.
Completely dead.
You cannot fund a $50 billion capital cycle purely through traditional corporate bond issuances and operating cash flow. If you try, the rating agencies will downgrade you immediately.
Exactly. The transition requires a fundamental rethinking of debt. The future of this industry belongs to the treasuries that can master alternative capital structures.
Right, like project finance.
That means executing deeply complex, non-recourse project finance. It means effectively utilizing green and transition bonds to access entirely new pools of ESG-mandated capital like we are seeing with European utilities such as NBW or Iberdrola.
Absolutely.
And it means structuring strategic joint ventures where the governance actually holds up under pressure. But even with those tools, I remain deeply concerned. Corporate balance sheets are dangerously exposed while they figure out this transition, and the execution risk is simply monumental.
The risk is monumental, yes, but I maintain that the industry is successfully navigating this incredibly complex pivot. They are actively using the massive cash generation of their present hydrocarbon assets to buy their ticket into the AI and transition future.
Time will tell.
As we look at the overarching narrative of this industry right now, there are really 4 core uncertainties that executives and investors have to confront in the coming months.
The first has to be the reality of capital allocation. Every board needs to ask themselves, are we actually funding our energy transition and our AI infrastructure ambitions from sustainable free cash flow, or are we quietly stretching our balance sheet and risking a credit downgrade just to keep up with the trend?
That's the billion-dollar question. The second major theme is valuation. If you are a traditional energy company moving into power generation, how do you ring-fence and isolate the valuation of your high-growth AI assets?
How do you avoid the discount, right?
Exactly. How do you ensure the market gives you a premium for your data center power rather than dragging it down with the conglomerate discount of your legacy hydrocarbon base? Halliburton's pivot with VoltaGrid is going to be the ultimate test case for this.
The third is execution. In the gold rush to capture all this AI power demand, have companies properly priced in the local regulatory friction? Because, as we discussed, if it takes 10 years to permit a transmission line due to local utility commission delays, the return profile of that project is entirely destroyed by the time it comes online.
And finally, there is risk management, specifically around the Treasury. Do these companies actually have the sophisticated financial architecture required to handle the massive cross-border foreign exchange mismatches?
Like the Gunvor deal?
Right. When you have 20-year dollar-denominated costs against multi-currency revenues, the working capital strains of executing simultaneous global megaprojects can be devastating if unhedged.
Those are the operational realities that will define the winners and losers of this supercycle. It's not just about who has the best vision, it's about who can actually engineer the finance to survive the build-out.
Perfectly said. Think back to our opening. They are trying to rebuild the engine of the global economy mid-flight, using the proceeds from the old machinery, all while the demand for power is growing exponentially. It requires flawless engineering and, frankly, unprecedented capital precision.
It certainly does.
There is so much nuance to explore in how these companies will navigate this tightrope, and we invite you to keep questioning the financial structures operating beneath the surface of the headlines. We'll leave you to draw your own conclusions on who will make it to the other side. Thank you for joining us on the debate.